Okay, hi guys. I believe you already have your copy of for sample problems for your qualifying exams. So we will be having a several parts tutorial video to assist you in studying for your qualifying exams. So to start with solve problem 1, we will be studying adjusting entries. So the Covidita Corona illustrators presented the following information pertaining to accounts that will need adjustments for its, take note, November 30, it's a fiscal year, November 30, 2020, fiscal or calendar year, it's crucial when we count or as to how many, say, expenses were already incurred or how much revenues were already earned. So here, our year end is in November 30. So please take note of that. For problem A, on October 1, 2020, Covidita Corona illustrators paid 10,800 for 6 months insurance premium. On October 1, we paid insurance premium that is good for 6 months. So problem A is an example of a prepaid expense. Prepaid expenses are expenses, as the name suggests, that are already paid but not yet incurred or used up. So when we pay for an item, we can either record it as an asset or as an expense. At year end, we have to identify how much of the asset is still unexpired, or say if we opt to record it as an expense, how much of the expense is already expired and vice versa. So if that portion is not yet expired, therefore it's an asset and it should go to our balance sheet. And the portion that has already expired is an expense that must be shown in the income statement. So take note, we are studying adjusting entries, and for every adjusting entry that we are making, it contains or includes one balance sheet account and one income statement account. Again, adjusting entries includes one balance sheet account and one income statement account. So how do we record prepaid expenses? So for example, we paid 10,800. So that means 1,800 applies for October, November, December, up to March. 1,800 for 6 months. Our year end is November 30. So that means October, November form parts of year 1, while December is the start of year 2. Okay. So when we record expenses, we have two options. You can use the asset method or the expense method. When we say asset method, you record the payment under an asset account. So in this case, we will be using prepaid insurance. When you say you use expense method, that means your payment was charged to an expense account. So in this case, it's an insurance expense. So under asset method, the 10,800 is all charged to an asset account. Under the expense method, the whole 10,800 is charged under an insurance expense account. Okay. So remember, at the end of the year, we have to identify if we record an asset, we have to take out the portion that is expired and record it as an expense, the expired portion. So if we record it as an expense, we have to take out the unexpired portion and have to transfer it to our balance sheet. Okay, clear? So in our example, October, November, this time already lapsed. So that means 1,800 plus 1,800, 3,600 is already expired, while here 1, 2, 3, 4, 7,200 is not yet expired. So the expired portion, again, it's an expense. The asset portion, the unexpired portion is an asset. Okay, I keep on repeating these terminologies so it's easy for you to remember the concept. So going back to our example, so prepaid insurance. So again, if we are to make an adjusting entry, we have to set up. So if we use the asset method, we have to set up the expired portion. So we have to come up with an expense account, which is the insurance expense. And we have to record for as expense method, we have to set up the asset portion or the unexpired portion. So again, for asset method, we record all the payments into an asset account. We have to transfer from this asset account the expired portion. And if we choose the expense method, we will be transferring the expired portion here, the unexpired portion rather, into this asset account, which is the prepaid insurance. So under asset method, 10,800 is the total payment, but only 3,600 was expired. So we have to transfer this to our insurance account, which is also 3,600. That's under asset method, the expired portion is our adjustment. Under expense method, 7,200 is not yet expired. Okay, insurance expenses are expired, so 7,200 not yet expired. We have to deduct the unexpired portion, and we have to record it here under an asset account. Okay, so at the end of the year, as you can see, prepaid insurance under asset method is 7,200. Insurance expense is 3,600. Under expense method, insurance expense is 3,600, 7,200. In short, this prepaid insurance account, whether you use the asset method or the the expense method, you will still get the same 7,200. Likewise, your insurance expense account under expense method, the net amount is 3,600. Under asset method, the net amount is also 3,600. That's the effect of adjusting entries. Okay, so to wrap up, under asset method, our adjusting entry as solution to our problem A is debit insurance expense 7,200, credit insurance expense, prepaid insurance 7,200. So the amount of the adjustment is the expired portion. Asset method, we take out the expired portion. And if we use the expense method, it's debit 3,600 prepaid insurance and credit insurance expense 3,600. So if we use the expense method, we take out the unexpired portion. So thank you for watching. Stay tuned for other parts of our video tutorial.
Panahon ng pagkakataon, may babalik bang kahapon?
Good day, everyone, and welcome to our virtual classroom. My topic for today is about depreciation. This is for intermediate accounting. So if you are new to accounting, if you are an incoming first year BS Accountancy, BS in Business Administration, BS in Information Technology, I suggest that you check my discussion on the basics of accounting and the adjusting entries. So, in my previous discussion, any item that has future value stays in an asset account. Then eventually, we transfer that when we consume or as time passes, we transfer that item to an expense account. So all of these assets, especially property, plant, and equipment, except land, has its time limit. So normally, these are usable for a number of years. So after which, they have relatively of little value for service or sale, or if not, zero. We have different names for that expenses depending on the associated assets. So the concept for this, depreciation, depletion, and amortization is the same. So it depends on which asset it is associated. For tangible assets, mga assets na nakikita, nararamdaman, nahahawakan, property, plant, and equipment, the expenses are called, the allocation of that expenses are called depreciation. For wasting assets or natural resources, assets na nauubos, nawawala, depletion ang tawag. For intangible assets, hindi nahawakan, hindi nakikita, hindi nararamdaman, amortization. So para mas madaling tandaan, isipin mo na lang ang mga expenses or pinagkakagastusan mo noon sa mga minahal mo dati. Depreciation ang tawag pag nakikita or nararamdaman pa. Depletion naman ang expenses pag unti-unting nawawala. At amortization yung mga sinayang mo nung mga panahong hindi mo na siya nakikita. Di ba? Mas madaling matandaan. Okay, next. So, let's discuss how we compute depreciation. So, depreciation by definition, it's also the formula for computing depreciation, where depreciation is the allocation of the cost or depreciable cost of the asset divided by or over its useful life. Okay, again, depreciation is the allocation of the cost of the asset over its useful life. When we say depreciable cost, it's the acquisition cost or the construction cost minus the salvage value. Salvage value is also known as the scrap value. At the end of the year, you can recover some amount from its scrap value. So we deduct it from the cost of the asset to come up with the depreciable cost. Okay, so let's proceed with computation of the depreciation rate. The most common method of computing depreciation is the straight line method. Straight line meaning we get the same depreciation expense amount every year. The annual depreciation is computed by dividing the total depreciable cost, meaning cost minus salvage value, over its useful life in years. So again, annual depreciation is equal to depreciable cost over its useful life in years. Then we will get the depreciation expense per year. The best example for assets that this depreciation rate is applicable are your buildings. When you construct a building, say in 2012, the same value, the same benefit, the company is getting out of that building, out of the investment they had from the building. So straight line method is the most appropriate method of allocating its cost over its useful life. But there are types of assets that are effective or most productive in the early parts of the asset life. So therefore, for this type of assets, straight line method is not the best method of computing depreciation. So meaning it's not the best method to match cost with its corresponding revenue. So one method that will solve that issue is the working hours method, where we get the depreciation per hour based on the estimated total hours that an asset is usable. So this method is usually best for assets like machineries. Okay. Another method of computing the depreciation rate that is similar to working hours method is the output or the production method. So depreciation per output is computed by dividing the total cost over the useful life, now in terms of the estimated total output it can produce. The most common or the best example for this method is a copier machine. Okay, let's apply those formulas in this problem. To make the most out of this tutorial video, I suggest you prepare your paper, pen, and calculators. Pause this video, solve this on your own, then go back to this video, play, and check your answers. That way you are practicing. So you're getting more out of this video by practicing. So let's proceed. Quarantino Company purchased a machinery at the cost of $845,000 on January 1, 2019. It was estimated that the machinery has a residual value of $45,000, or the scrap value. All of its life in years, 5 years, in service hours, 80,000 service hours, and 100,000 based on units to be produced. Okay, so we will be using those three depreciation methods that we have learned just now. Okay, so you have here your operations, hours, and units produced. So first we will use the straight line method. So in straight line method, depreciable cost is divided in the number of useful life in years. Then you will get the annual depreciation. So it's 845,000, the total cost, minus 45,000, the scrap value, divided by life in years, which is 5 years. So our annual depreciation is 160,000. So if we plot that in our depreciation table, so you will get this. So you put the years here, depreciation, or the depreciation expense per year. That's why it's called straight line. So it's straight 160,000. So take note, we only allocate 800,000 over its useful life. That's the depreciable amount. Accumulated depreciation, or the total depreciation per year. So year 1, 160. Year 2 is the total of these 2 years, 320. Year 3, 480. Total of these 3, and so on. At the end of the life of the asset, its carrying amount is equal to the scrap value, or the unallocated portion. Okay? It starts with the cost and it ends with the scrap value. So that's for straight line method. Straight depreciation expense, or uniform depreciation expense, each year for the entire years of the asset. Then we have the working hours method, where the total depreciable cost is divided by the total hours expected to be served by this machinery. Okay, so our depreciable amount is 800,000 divided by 80,000 total expected hours for this machinery. So you get 10 10 pesos per machine hour. Okay, so you get 10 pesos machine hours. So now, for this entire, for all these years, so number of hours times depreciation rate, which is 10 pesos, we get just now, is equal to the depreciation expense for that year. Then for 2017, 17,000 times the depreciation rate, and so on. Depreciation now it's 170, 180, 170, 180, 150, 120. The concept is the same with accumulated depreciation. Year 1, this is year 1 plus year 2, this is year 1 to 3. Carrying amount is the same. Let's start with the acquisition cost. Carrying amount minus the depreciation expense is equal to the carrying amount of that year. So 665,000, for example, here, minus the depreciation for 2020, which is 170,000, your remaining carrying amount is 495. Likewise, for 2021, 495, the beginning of 2021, 495 minus 180 here. For 2021 depreciation, you will get the carrying amount of 315. And as always, the last year's carrying amount would be equal to the scrap value. And lastly, depreciation based on the output method. So again, depreciable cost divided by the estimated total output. So 800,000, the depreciable cost. Our expected units in our problem is 100,000. So we'll have 8 pesos depreciation rate per unit. So units produced per year times the depreciation rate per unit, you will get your depreciation for that particular year. So units produced in 2019-22 times 8, you will get this depreciation expense. Likewise for 2018, 2020, 2021, 22, and so on. So these are your depreciation expense. Accumulated depreciation is the same this year. Then this 2020 is equal to 2019 plus 2020 depreciation. So 2021, again, depreciation for 2019, 20, and 21. If you observe, your carrying amount is still 45,000, which is equivalent to the scrap value for this machinery. So stay tuned for the continuation of this video tutorial. We will be discussing another depreciation method, which is the sum of the year's digit. So hi guys, it's coffee time. Oh, I mean it's accounting time. So let us continue with our adjusting entries series. Previously, I have uploaded part 1, which is about prepaid expenses. So I've decided to jump into unearned income and skip part 2, which is about depreciation, because the concept of prepaid expenses is somewhat similar to unearned income since they are under deferrals. Another issue, our format of discussion here is more focused on the concept, the analysis of the problem. rather than the theories, because I wanted to give you bite-size, easy to understand accounting. So as I've said, prepaid expenses and unearned income are under deferrals. So when we say deferral, we defer the amount into a balance sheet account and later it is moved into an income statement account. So simply stated, when you defer something, say in expenses, it stays here in the asset account, which is a balance sheet account. So we defer under a balance sheet account and later we transfer it to an in an expense account or an income statement account once it is expired. Likewise, when we recognize income, so it stays in a liability account, balance sheet account, until it is earned. So later it's transferred, the earned portion is transferred into an income statement account. Okay. To understand it further, let's continue discussing Covita Coronel illustrators. Never mind if you don't have the copy of the problem, I'm flashing it in our screen here. So on November 1, 2020, 22,800 was received from our customers for services to be rendered for the month November, December, January, and February. So remember, our year end for Covita Corona is November 30, 2020. Okay, so what are unearned income? So as the name suggests, these are income that we have received, but technically it's unearned, so not yet earned. Meaning we haven't delivered goods or services yet to our customers. So the timing is that cash comes in first before the earning process. Okay, so once we recognize unearned income, it can be recorded as a liability or as an income. So we just have to watch out if it's not yet earned, it must be set up under a liability portion. It will now be transferred to an income statement account. Okay, as a reminder again, we are preparing here adjusting entries where every adjusting entries includes one balance sheet account and one income statement account. So unearned income. The customer paid us 22,800. That is good for 4 months. 700 here applies for 4 months. But remember, November 30 is our year end. So how do we record this? Prepaid expenses has 2 methods. Unearned income has also 2 methods of recording unearned income. One is liability method, and another one is the income method. So under liability method, the whole thing is recorded under a liability account. Unearned service income is a liability account. And under income method, the whole thing is recorded under service income. So the whole 22,000 is recorded as a liability once we receive the 20,800. And if we opted income method, 22,800 are all recorded as service income regardless if it's not yet earned. So initially, we recognize the whole thing as service income. At the end of the year, so again, we have to reminder, we have to take out. If we record it as a liability, we already earned a portion of that. So you have to transfer it into an income statement account. Likewise, if we opted for an income method, some of these are not yet earned. Therefore, it's a liability. We owe it from our customers because we haven't rendered or delivered the goods or services yet. Okay. So 5,700 here is earned, and 1, 2, 3 months not yet earned. So 5,700 earned, 17,100 the unearned portion. So we can recognize 5,700 as income, 17,100 as a liability. We owe it from our customers. So to recognize adjusting entries, so under liability method, we set up the income portion. Remember the 5,700, and under income method, we have to take out the unearned portion. So you have to set up the liability. Okay, so we earned 5,700. We take out this from the liability portion, and we can set this up under service income. So at year end, we can now recognize 5,700 service income. So likewise, in our income method, out of this 22,800, our remaining liability is only 17,100. So therefore, we have to set up 17,100 as our liability at the end of the period. Unearned service income is a liability account. So at the end of the year, using liability method, we have 17,100 under unearned service income. Under income method, service income net is 5,700. Unearned service income, 17,100. Again, that's the effect of adjusting entries where whether you choose the liability method or the income method, after recording these adjustments, the yellow portion, you will still have the same balances. So 17,100 here under liability method and 17,100 here also under income method. Likewise, service income to be recognized at the end of the year, 5,700 under income method and 5,700 also under the liability method. So to wrap this up again, our adjusting entry under liability method is we debit unearned service income 5,700. We are recording for the earned portion rather. So under liab method, we recognize the earned portion. Under income method, so debit service income, credit unearned service income. So we set up the unearned portion. Income method, the adjustment is the unearned portion. So thank you for watching, and hopefully we will see each other soon in our succeeding accounting tutorials, math, and engineering. Please do subscribe to help us inspire to do more videos. Thank you very much.